how does money actually work? How does it really, really work? Because we understand what, Wall Street or, the IRS or whoever it is wants us to understand, but we don't always have all the information to make the most informed decision when it comes to money. So here's an example of that, the 401k. So for most of us, especially if we're higher income earners, we are maxing out our 401k because we believe that we're going to get this tax benefit. And in fact, yes, you will get somewhat of a tax reduction in your current year taxes if you put your contributions in there on a pre-tax basis. But what we're not thinking about is all the time that our money is sitting in our 401k account, especially those pre-tax dollars, whether that's 10, 20, 30, 40, 50 years, that account is growing. And so your tax bill is growing. You're literally contributing to an uninterrupted compounding tax bill inside of your retirement plan. Wow. So at the time when you actually need to access that money, when you're no longer actively working, you're going to have to pay a much higher tax bill. And if you're in, like I have a lot of clients in California, New York, and these high state or high tax states, when it comes time to actually take out that money out of your 401k, many people, when I run the numbers for them, they're going to realize that actually the balance that they have is probably, what they'll actually pocket is probably going to be 2/3 or maybe only a half of what they actually thought they were going to have. And it's shocking, but it's true. And so I try to help people understand, because no one ever talks to us about that. They just say, yeah, max it out so that you can save on the taxes today. Yeah. But no one ever talks about what's the impact of doing that down the road when we actually need to pull out that money. So between fees and taxes, like I said, it literally for some people can be anywhere from 1/3 or half of their balance is gone. It's disappeared. So they've been working all those years and putting it away for all those years and being disciplined, but they only end up with half of it.
Let me play devil's advocate real quick. I'm going to jump in and say the argument is, though, even if your balance is large, you're only pulling out a certain smaller amount per year. So you'll get taxed on that smaller amount. Does that still apply?
Absolutely, it still applies, because we can't forget about the time value of money. So the longer your money is sitting in that account, assuming it grows, I mean, of course, you could have a market crash and it gets cut in half, like what happened to people in 2008, but assuming it continues to grow and increase, you're paying taxes on that higher amount, right? So let's just say, for example, you've been putting money in up to age 65. Okay. Let's just say you have $1 million balance at age 65. Yeah. If you keep that money in there, so what most people will do is they might say, okay, I'm going to pull out a certain amount so that I've maybe depleted it by, let's say, age 85, because number one, you don't know when you're going to pass away, right? Yeah, but let's say that they've kind of figured out, okay, I'm going to calculate pulling this out, because hopefully they have money in other places. So they're just going to focus on retirement monies that they use over that 20-year period from age 65 to 85. Mm-hmm. Well, in that 20-year period, that money, even though you're not contributing anymore, that money, that balance is still growing. Okay. Mm-hmm. And let's just say, and when I show my clients, I just show them based on the fact that they're still in the same tax bracket, right? Mm-hmm. It's highly unlikely that 20, 30 years down the road that the tax brackets that exist today are going to exist down the road. I personally believe that they'll be higher. I can't prove that, but there's so much debt on this country. I can't imagine them not increasing the tax rates. So they might say, okay, well, today I earn, let's say, $250,000. And so I'm in, this tax bracket. Well, when I'm, 20 years down the road, or when I'm, 65 or 85, when I pull that money out, I'm not going to need to pull out $250,000 because I don't, I won't need that much. But when we look at inflation, okay, Nicole, we've just seen recent reports that we've been using 3%. But it's really forever. 5, 7, depending on what you're looking at, whether it's gas, food, health, healthcare, inflation, or the cost to buy things. That purchasing power is actually getting reduced. So what you can get today for $250,000 is you're probably going to need, $400,000, 20, 30 years from now when we look at inflation. So if you don't think that you're going to be pulling out at least as much as you're using today, it's probably, you're probably just not understanding how the math really works, how the numbers really work, right? So I tell people the real strategy is doing, what might feel like the hard part today, which is just pay those taxes today because we know what those taxes are. So just get that out of the way today, and then redirect your money into vehicles where it can take advantage of that, right? Where you're not going to build up a tax bill. Deferring taxes is putting yourself in a position where like you don't know, right? And I believe that we should be planning for as much certainty and as much control in the future as we can. So that would mean for me, in my situation, I had immediately just stopped contributing to the 401k period.
Yeah.
But for some people, they just said, okay, I'm just going to put, 100% Roth. Fine. If you still want to contribute, just do Roth. Don't do pre-tax monies. Now, you're still going to have those fees that are going to be whittling away, that annual, fee that's going to whittle away at your balance. But at least that tax bill isn't growing, in the meantime. But if you were to just redirect those contributions from a 401k into something, say like a whole life insurance policy, yes, your money grows tax deferred inside of the policy, but you're able to access it, right, without a tax consequence. So you're actually building up an asset. So the one key thing is that, and a lot of people don't understand this either, is your 401k, if it has pre-tax dollars in it, it is not actually your money, right? It's the IRS's money. Until you have paid those taxes, it really isn't your money. If you see, a statement, if you ever roll it over to another custodian, you'll always see that it will say, in care of, in benefit of Lesley or, whatever, but it doesn't say this is Lesley Batson's money, right? And that's because as long as there's still some tax due on it, it's not really your money. Honestly, it's the IRS. And that's why in most cases, like a bank they won't accept your 401k as collateral, anything like that, because the IRS is going to get their money, right? Whenever they need it, they need to know that it's not, committed to a bank or someone else. If you, can't keep up with that loan, the IRS is going to get their money first, right?
Oh my goodness. So, sorry. All right. I just want to interject because that was just such a shift in mindset. Thinking of a 401k, a 403b as uninterrupted compounding tax bill later. Like I never even thought of it that way.
That's truly what it is. Yeah.
It makes so much sense. And I actually stopped, like I'm on your same page. I've stopped contributing to my 403b. I only do up to the match just for what the hell, like I might as well get the match if my job is going to give me half. So it's like 3%, so I do very minimal because I'm going to use other vehicles. And I know there's other things out there. But yeah, so I think, thank you for that. Just that one nugget just basically made me have a shift in how I think about it. And even with a Roth. So will a bank, you said with the 401, because you don't really own it, it says in care of, which is another mind blown moment. But with a Roth, if you're going to do the Roth, because that's what you feel comfortable with, can you borrow against that? Is that really now your money because that's already taxes paid on it? You still have a penalty if you withdraw too early.
Right. So there's a difference between loans and withdrawals, right? So if you have a Roth, like if we're talking about a 401k, right? So if you're still actively employed and your 401k is still there, you can take a loan. I mean, you can take a loan from a 401k, whether it's Roth or non-Roth, right? But the key difference there is that, so let's just say, again, you've got a 401k, let's say you have $300,000 in there. Number one, in most cases, if you want to take a loan from your own 401k, you can take a maximum of $50,000, right? So they limit how much you can actually take out. So usually it's a maximum of $50,000. Usually it's a maximum of 5 years that you can take that money out. They will, they will start taking back loan payments, essentially from your paycheck. Some limitation on the control. But the key thing is when you take that loan, that $50,000 is coming from your money. So your balance drops to $250 while you go use that $50,000 elsewhere. Okay.
So it's not compounding uninterrupted.
Right. That those $50,000 don't get a chance to grow anymore. Yeah, it's great. You're able to use them for whatever you pulled them out for, but it's not growing in the time that it takes for you to pay them back. Compared to, say, an IRA, if you have a Roth IRA, you can't take a loan against an IRA. So you would have to do a withdrawal, or you just have to use it, whether it's for investing or otherwise. But I mean, you can take a withdrawal up to the monies that you have contributed. That's like the cost basis of that. You can withdraw income tax free. any earnings that are beyond 5 years, as long as that those earnings have been in there for at least 5 years, you can access those income tax free. But if you take any monies out within that 5 year, that 5 year window, you could be subject to taxes, right, from a Roth. So, but again, the key thing is with the Roth, there's those restrictions, right? It's still that the IRS is kind of setting some rules as to how you can access, your own money, right?
Yeah.
Did you love this episode of Share the Wealth Show? If you know of someone who would benefit from this information, don't keep it to yourself. Share the wealth and make sure to leave us a rating and review. We'll see you for next week's episode. Subscribe so you'll be notified.